Hey, this is Cary Smith, and I'm sitting here with Amar Shah. We're with Client First Capital, and today we're doing a look back at 2023 and all of the economic data and things that impacted our economy, our growth, and our portfolios, so that can better help us inform us for how to be prepared for 2024. So, Amar, anything else to add to that intro?
No, I think that's good. We should just hop right into it. Like you mentioned, first we're going to spend a couple of minutes talking about 2023 and then 2024. What was interesting about 2023 is that economic data was roughly about the same as 2022, but the market's reaction was drastically different. So here you have two slides that we put on one page. In 2022, you can see the markets were going down, and then in 2023, you can see the market skyrocketed up. But the point that I was trying to make here is that most people are still down. If you look over 2 years, they're probably down anywhere from 0 to 5% because of sequence risk, right? So when you have a large drawdown, you have to make that up by having a large upswing. And the upswing, although it was great, it may not be enough to offset some losses from a year ago.
Amar, I definitely see the value of looking at the 2 years together. But man, when I look at this chart and I see 2023, it was a really good year for the markets.
Yeah.
And what's strange is it never felt like it, right? And,
Right.
we always had the risk of a recession hanging over us, and the probabilities getting higher or less and higher again, right? And interest rates rising and everything else. So it didn't feel like it was a really great year, but when you look at the data, it really was.
Yeah. Yeah, absolutely. And what happened? And how was it a great year? Because there wasn't much breadth in the markets, but the companies that were doing well did significantly well. So we have the Magnificent Seven, which is basically technology companies that have AI component to it. They were up roughly 75%. The 493 other companies, they were up about 10%. You know, so that tells you kind of a drastic story of dispersion. If you were diversified, you probably didn't do as well as the market did.
Yeah, you and I have talked about the Magnificent Seven, a few times throughout the year. But to see it on the slide, right, it really just kind of brings home how dramatic their performance was.
Yeah. Yeah, and everybody in 2023 had recession on their radar, right? Here's the U.S. recession probability, and you can see last year, we almost got up to 75% probability of recession, but we stayed it off, and I think one of the main reasons why we stayed it off was labor, right? And labor continues to be strong, even though about a quarter of jobs were created by the government last year. Jobs were created, and in terms of jobs that were created, they actually paid well as well. So we have 4% growth in average hourly earnings, as well as when you look at real earnings relative to inflation, we're in the positive. So people were making money and they were able to slightly outpace inflation.
Yeah, the labor market has just really been incredible. I remember hearing on an economics podcast in late December that, there were still 1.3 jobs for every unemployed person, right? And so the labor market has continued to perform well, and it's also good to see that those jobs are paying better also.
Yeah. One thing that when we look at going into 2024 is like what's happening with inflation, because that's the number one concern of the Fed, right? And before we look at 2024, we should realize that over the last 3 years, things have gotten expensive. If you look at the gross amount, we're at 17.27%. So roughly, 17 to 18% more expensive for items. Some items maybe even more than that. For example, food. But inflation overall is coming down from the peak of 9% to roughly around 3% where we are today. Um, Rates being a big piece of that, although rates are high right now or feel high because in the recent past rates were so low, it abnormally low to say. But we are, in a period, if you see in this chart, 61% of the time rates are between 3 to 6%. So we are within that range.
You know what I like about this slide, Amar, is we were in a low interest rate environment for so long that started to feel like the new normal, right?
Yeah.
But the old normal is still the normal, and it seems like we're headed back to what I think is going to be normal, at least for a while.
Yeah, absolutely. And another thing that's on people's mind is housing, and rates have increased. Like if we look at the purple line here, starting 2022, it's almost gone vertical, if you will, um, and peaked at 7.7%, and now it's back down to about 6.61. Housing's difficult because a lot of people have refinanced at these lower rates that are kind of, I think, Cary, you called it stuck, and that's kind of like me. The we love our rate more than we love the house, but we don't want to give up the rate in order to get a bigger house.
Yeah, I think for a lot of people, housing is probably their biggest story, right, for 2023, right? Because they're either stuck where they're at or they just can't buy into the market, right?
Yeah.
And so they continue to rent.
Yeah, and I think it also paints a picture is that the consumer is probably delaying things that they would have done. So, like, take me for example. I have two young children. They share a bathroom. If anybody's had a sibling, sharing a bathroom with a sibling is never a fun situation. But we're not looking to move, right? Because the cost of moving versus figuring out a solution in our existing home, like remodeling or something like that, probably makes more sense. And I think the consumers has that train of thought for multiple things beyond just housing. Like even take your smartphone. You may upgrade your phone every cycle. If that was you, you may now wait a cycle or two. You may postpone some big purchases. So the consumer is definitely having some pain, if you will, all around. And we can see that more so by looking at just debt levels. So credit card debt levels pass $1 trillion, right? And the average credit card rate is 23%. So mortgage debt, 12 trillion, auto loans, a large amount of debt there. And so household debt just continues to increase and be a bigger part of the burden on consumers.
Yeah, this on this slide, although this is 2023 data and before, it really does paint the picture for 2024, right? And because these debt levels are going to have to be dealt with at some point, and I think consumers are going to have some trade offs as we go into 2024 and probably 2025.
Yeah. And when you have all-time high debt levels, you also have all-time high delinquency levels and other parts that are tied to this. For example, Discover Credit Card just reported for Q4 of 2023, they had $1.9 billion of losses, and they have their 90-day delinquencies are up significantly. So
Yeah.
it's really the picture's just starting to be painted, if you will.
Yep.
And that debt picture is the same with the government debt, right? When everybody was refinancing at those all-time low interest rates, the government didn't refinance any of their debt. And so now we're in a position of 2024 where we have a bunch of debt that was issued that is coming due, that had zero, close to zero rate, to now we have to refinance at a higher rate environment. So that will play a role in the Fed's ability to create liquidity as well. When we look forward, we look at growth and inflation. Growth looks like it's trending downward. This yellow bars here are the consensus. The inflation, looking forward, is projecting to be right around 3%. And so we're in this weird position, and we're in an election year on top of that. So I thought I'd throw this slide in here, that it really doesn't matter. The market is looking for green. It's not looking for red or blue. And even if you think it is, it's roughly the same. So when we look at 2024, I think we're in a position where there's two highly probable scenarios. One is that you do have a recession, a hard landing. Stocks can take a big dip, if you will. Typically, that dip is 30%, but I think the Fed, as well as Congress, in an election year would probably step in quite rather quickly and kind of create more liquidity. So that would stem some of those losses. But that also increases the inflation problem later down the road. And then I also think that the probable outcome is that companies are paying well, jobs are job numbers stay sticky. Companies are reinvesting in AI, manufacturing, infrastructure, and then we're just in this slow growth environment, right? And the problem with that could be that the people that are thinking that there's 6 or 8 rate cuts, or the Wall Street consensus is that there'll be 6 or 8 rate cuts, well, they're going to be disappointed because their models are not going to work. And when that reality comes to fruition, then some of these company stocks could probably drop significantly. So in either case, there could be a period of pain in 2024, followed by strong, stable growth after that.
Okay, Amar, I appreciate your work on the slides and just sharing that data. That was a good, fairly detailed look at the year behind us, but also, gives us some indicators of what the year ahead is gonna look like as we transition into and move through 2024. And let me just say, if you're out there and you're watching this, and you need to have a good grasp of how much risk is in your portfolio, you need to take a look at your personal situation. Everyone's different, right? Everyone has different goals. Everybody's at different stages in their life, and also in their investing and financial life. And if you want to just have a better understanding of your risk, and also a personalized plan to help you have success with your finances moving forward, I would say just reach out to us. You can click below to reach out to us, schedule some time for a conversation or a consultation, but also you can subscribe to our newsletter as well.
Sounds good, Cary.
Okay, Amar, thank you. Have a good one.